Hello and welcome to the third and final learning module. This learning module will consist of petty cash fund, reporting cash and cash equivalents, and calculating free cash flow. Petty cash is a fund of an amount of cash kept on hand to pay for minor expenditures. While the size and scope of petty cash fund will vary across companies, its operation will involve the following three activities. So of those activities, we first establish the fund. Then, after we have the money, like in a cash box in an office, people will come and ask for money to pay for incidentals. So we make payments out of that fund. And then when the fund gets down to a certain amount of money, we will need to replenish the fund, bringing it back up to its original amount. And this could happen weekly, could happen monthly, and it could happen bi-weekly. So our first journal to take a look at is that journal entry that we use to establish the petty cash fund, excuse me. So a journal entry is made to record the establishment of the fund. In this example, assume that Barrett Design Group cashes a $100 check to establish a petty cash fund and give the cash to John Stevens, the custodian. A debit to record the petty cash is done, as you can see here. And this petty cash account would be an asset in your asset account, in your asset category, right around cash. And then we're going to do a credit for cash. Now, as people come and get that money out of a cash box, out of an office to, get gas or pizza or beer Friday or office supplies, it's small amounts of money that you just don't want to have to write a check for every time. And so that's why we develop these petty cash funds. When you make payments from the fund, you never go to this fund. You're going to bring back the receipt and any change to the custodian, and they're going to keep track of it. So as you make payments from the fund, there's no other journal entry done at this particular time. The journal entry is done when we replenish the fund. And here is an example of replenishing the fund. And so what you'll see here is you'll see, hey, we started with $100. There's $15 remaining in the cash box. So that means we had to have spent $85. So we add up all the receipts, and lo and behold, we have $85. So in this particular case, we're going to go ahead and put them to each of their expense accounts in our general ledger. This is an adjusting journal entry. We're going to go ahead and debit postage for $25, supplies for $47, and miscellaneous for $13. We are then going to write a check for $85. The bank is actually going to give us cash for $85. And we're going to come back to the office and we're going to put it back in our cash box. We then now have $100 more for people to come in and use up. Every time it gets down to that certain amount, then we will go ahead and replenish the cash fund. Now, a perfect world. So if we weren't in a perfect world, which is what this example is showing us, although there is an error on this particular slide from the manufacturer, and that is that sometimes when we add up the receipts, we don't have exactly what we should. So in this case, we're going to pretend that we added up all these receipts and they were really $83. So that means that we need $2 more. So let's say miscellaneous was actually $11. So that means we need $2 more to make the $85. So in this case, we would debit postage, debit supplies, miscellaneous really would be $11 if this example was done correctly, and we would have an amount we call cash short and over of $2. And then we would make an actual check for $85. So when you don't have the exact amount of money that you should have after what you have left, then the difference will either go to short, which will always be a debit, so short is a debit, or you will go to credit, which is what you will use for over. And so let's go ahead now and take a look at. I'd like you to turn to page 124. So page 124. and we're going to be looking at exercise number 5. Exercise number 5 says on June 1, CWA Enterprises established a petty cash fund for $250. Our instructions are to include all of the journal entries for the month of June. So we're going to start with that first journal entry, which is to establish the petty cash fund. Establishing the fund. And we're going to do that by debiting petty cash for the $250 and crediting cash for $250. That would be our first journal entry, and that is establishing the fund. Our second journal entry is now to record all of the receipts that we have. And so what I like to do is when they give it to me in this problem, then I can go ahead and take a look at those. So they tell us that the cash remaining is $76.25 is what's remaining in the box, and that they've spent postage. So they've spent postage of $36.50. They've also spent $76.45 for office supplies. So we'll go ahead and write that down, office supplies. They've also spent $60.80 for miscellaneous items. $60.80. Okay? So let's go ahead and figure out what we should have and what we have. So our beginning petty cash was $250. They're telling us that what we have remaining is $76.25. $76.25. So if we do the math on that, let's quickly take out your calculators and let's go ahead and take a look at what that is. You have to give me a minute as I pull out my calculator. All right, so we have $250 minus $76.25, which means that I should have receipts totaling $173.75. Let's total our receipts and see what we have. We have $36.50 plus $76.45 plus $60.80, and that gives us $173.75. So that means that we're going to write a check for $173.75. Let's double check the math there. $36.50 plus $76.45 plus $60.80 gives me $173.75. So that is in fact what we are going to write the replenishment check for. This is replenishment. Now, if this had only equaled, if our receipts had only equaled $173, then we would do a cash short and over for 75 cents. So remember, your debits and credits have to equal. So if your receipts do not total to the amount of what you need, you will need to add a cash short and over. Next, we're going to go and take a look at something we call cash and cash equivalents. The definition of cash and cash equivalents, and as you know, cash takes many forms. There's coins and dollar bills in your pocket, you have a checking and savings account, even a check from a friend that has not yet been deposited. Money orders and traveler's checks, although those are kind of archaic now with debit cards, are other examples of cash. In addition to these forms of cash, companies often hold investments that are so much like cash that we deem them to be equivalent to cash. A cash equivalent is any investment that is readily convertible into a known amount of cash and has an original maturity of 3 months or less. In some cases, though, a company will restrict some of its cash for specific purposes. So examples of cash equivalents are coins, bills, checking, savings, money orders, traveler's checks. Cash equivalents are treasury bills, certificates of deposit of money, money markets, commercial paper, as long as they mature in 3 months or less. Common stock is never a cash equivalent. So as we go ahead and take a look at that, let's go back to page 124 and let's just do a brief example. And we're going to look at exercise number 6. At the end of 2012, a company has a $10,000 certificate of deposit that matures in 120 days, $60,000 of cash in a checking account, and $100,000 in a 1-month T-bill. What would be the balance of the account cash and cash equivalents on the balance sheet? Well, let's go ahead. So the $10,000 certificate that matures in 120 days would be no. It's more than 3 months or 90 days. Okay, so the first one would be no. The second one is $60,000 in the checking account, so that would be yes. And then we have $100,000 in a 1-month T-bill, and because it's a 1-month T-bill, that also would be yes. And that amounts to $160,000 would be in cash and cash equivalents on your balance sheet. Okay? Thing before we go, we're going to go ahead and take a look at one more item, which is calculating free cash flow. But first, before we do that, I want to briefly show you some details on the financial statements regarding cash. This is for Domino's Pizza. And so what you see here is you see these notes to the financial statement, and you can see where it's reported here on the balance sheet. And in the notes, they've given you some details. They tell you what the cash equivalent equals, and then they also show you what the restricted cash flow is. So when in doubt, your notes to your financial statement should always address the company's cash balances and what they're made up of. And here they kind of give you highly liquid investment, maturity in 3 months or less, they're carried at cost. And so any details that you need, you can get from the notes to the financial statement. Our last item here, Module 3, and before you're really free for spring break, is something that we call free cash flow. Companies need to generate enough cash to pay its bills. So when they do that, they need enough cash to maintain its capital expenditures and also reward its shareholders with dividends. If a company can generate more cash than it needs for these commitments, it is generating what we call free cash flow. The formula for that is you go to the statement of cash flows, which I know you have not done, but you're going to look up the line item that says cash flow from operating activities. You then will subtract capital expenditures and dividends, and then that dollar amount is what free cash flow is telling us. Remember, a company has enough money to pay its bills, which is coming from the operating section, enough money to buy buildings, land, equipment that it needs, and then to reward the shareholders for giving them money or loaning them money and hanging in there with them in the form of dividends. We're going to go ahead and do a final exercise, which is also on page 124. On page 124, number 7, it says during the year, a company had net income of $145,000 and cash flow from operations of $195,000. During the year, the company bought new pieces of equipment and $10,000 of dividends were paid. So what is our free cash flow? So we don't care about the net income. What we care about here is the cash flow from operations. Cash flow from operations. And in our world, the cash flow from operations is $195,000. We're going to subtract that amount that we bought equipment for. That's our capital expenditures, and I'm going to abbreviate expenditures, which were $45,000. And then we're going to subtract the dividends, which is going to go ahead and give it, which was $10,000. When we do that, then our free cash flow is 195 minus 45, so that gives us 150, minus 10 gives us $140,000. And so what we're going to do now is you're going to take this newfound knowledge in modules 1, 2, and 3, and we're going to go ahead and have you attack your Cengage homework assignment, which you will find out on Cengage. Just a couple things that come to mind that students typically ask questions about is, one, if you need to use your cash short or over, remember that short is your debit, over is your credit. In addition to that, you never go back to the petty cash fund unless you're going to increase it or decrease it permanently. Also, when we take a look at cash equivalents, common stock is never included. I hope this has been an enjoyable experience for you, and I look forward to your feedback and hearing about your experiences both doing more accounting and spring break. Have a good week.